Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. Over the next 30 minutes, we'll be your guide to the region's market and exchange-traded funds, everything you need to know about the funds and the flows. Global stocks week in the red after Europe's stock 600 tumbles the most on record. Equities indices around the world sink into bear markets. With the stock 600 rebounding after losing more than $4 trillion since its peak, we'll discuss what the week's volatility means for ETF investors and markets. And as crude oil gets crushed this week, 2 European exchange-traded products shut their doors. We'll ask if more closures could be set to come. Now, following this week's rout for global stocks, in this special edition of ETF IQ Europe, we're going to focus in, of course, on the sell-off. We'll ask what it means for investors and also discuss the implications for the future of the ETF market. Well, let's kick off with some analysis of this week's rout. Danny Berger's been looking at the numbers. Hi, Danny.
Hi, Francine. Well, whether you own mutual funds, hedge funds, or ETFs, it was certainly a dramatic week in markets. Let me set the scene. About 20 regional benchmarks went into a bear market this week. We saw major indices in Europe, in the U.S., and throughout Asia. Here's just some of them. The main ones, of course, the stock 600, the country all-world index, hitting that 20% tumble from the all-time highs. It seems that the action from central bankers this week was not enough to placate investors. We saw the tumble increase as Donald Trump placed that travel ban in Europe. Now, for the most popular ETFs, they were not immune either. I want to look at the 1-month return for them. Of course, this is through the Friday morning, and we see all of them falling around 20%, again, reflecting that underlying bear market that a lot of them went through. So again, these are the most owned ETFs in Europe. This one, the top 2 S&P 500 ETFs, falling more than 20%. Of course, S&P 500 entering a bear market. Interestingly, though, didn't see a ton of outflows in this one, actually inflows for the week, so ETF investors holding steady. As for the other one, the world ETF, again, entering a bear market. And finally, emerging markets as well. One of the issues, though, this week, if you were an investor who hold both bonds and stocks, you had nowhere to hide. Diving into the charts, looking if you own the S&P 500 and BlackRock's long-dated bond ETF, you saw losses. Bonds did not protect you, even if you held that long-dated bond ETF. So over here, these are 2 consecutive days of declines of more than 8.5%. Essentially what happened, diversification failed, even though bonds, again, are supposed to protect you. The 30-year yield skyrocketed above 1.4% by 1 point on Friday. On Monday, remember, it had fallen below 1%. Quite the difference. So 30-year yields getting hit. One paper from Oxford University says that diversification fails in a fire sale. That's because investors own everything, so they sell everything. So yes, you could be an ETF investor who holds this BlackRock ETF and holds stocks, but that in itself really was not enough to protect you. We saw that this week with gold, even though the inflows were there as well. We saw that even with Bitcoin. So again, all of these different markets really struggling to keep up. So definitely an interesting week, regardless of what ETF you held, Francine.
Danny, thank you so much. Danny Berger there with a look at the week that was. Now joining us this morning, Deborah Furr, Managing Partner and Founder of ETF GI, and James Bevan, Chief Investment Officer at CCLA Investment Management. Wow, what a week. I mean, I don't know if it's fabulous or not, but alive, Deborah, we're lucky to be alive. Deborah, when you look at exactly what happened this week, how big of a role did ETFs play in all of this?
Well, I don't think ETFs played a role in terms of causing anything to happen. I think what is important is that ETFs actually are doing what they're supposed to do. They've traded well. So we actually saw yesterday that the SPY ETF in the U.S., the S&P 500, traded $99 billion. So we've had $1 trillion of trading volume in the past 15 days in that product. So we're seeing that they trade well in volatility. Yeah. Creation redemption really works. So all this fear mongering of ETFs not doing what they're supposed to do has really been dispelled, but no one talks about that.
But so, Deborah, does it mean that actually there will just be more people using ETFs in the future in this kind of sell-off that we saw this week?
Well, we saw outflows here in the European products, but in the U.S., we've actually seen month to date 24 billion of net money going in, 16 going into equity products. So people are buying the dips in some cases because they see it as a buying opportunity. Yeah. So yes, I do believe people see the benefit of ETFs. Liquid, transparent. There are concerns now. The FCA is looking at liquidity around traditional mutual funds because of what happened last year with one of the funds. So I do think people see the benefits of ETFs.
How do you see ETFs having behaved?
Well, I think they're very important. I would say that there is a much bigger issue for the market generally, which relates to passive, and it's very easy to conflate the issues of exchange-traded funds with passive investing, and of course that's not the correct story. But if you are selling an index, despite the fact it gives you a lot of liquidity, you're very indiscriminate. And I would say this is a market where people will be able to gain significant benefits through the correct focus on stock selection rather than index participation.
Okay, will that change?
Now, I think that people will recognise that in an environment where growth is going to be hard to come by, where inflation is likely to remain low for the time being, you should rationally pay up to participate in long-term real growth. So companies like Stryker, Medtronic, Diageo, these are all names that I think will bounce hard when the bounce comes. And, of course, you don't get full participation if you're in an index fund.
Deborah, given the week we've had and how ETFs were used, are we going to see just much more appetite for ETFs in Europe?
I think we will see more appetite, and I would say that there now are many sector ETFs, there's thematic ETFs, ESG has become very popular, so not all ETFs buy the entire market. So I think you can be very focused on themes, sectors, disruptive technology, things people want to invest in. So I would say that we're not just seeing people buying necessarily the broad market.
Deborah, is there anything this week that you wish could have worked better?
Healthcare. Well, I think in ETFs it's worked well. I'm just concerned about the healthcare situation.
The healthcare,
meaning corona.
The coronavirus.
I mean, what we saw in the U.S. was a discussion of people who had died of the flu potentially having the coronavirus even before it came about in China. So that changes the dialogue quite significantly. So.
Okay, we'll talk a lot more about these market dynamics. James Bevan from CCLA Investment Management, Deborah Furr from ETF GI stays with us. Now, coming up, we'll get more on the sell-off roiling global markets this week. Plus, as two exchange-traded products close in the wake of collapse in the price of crude, we'll ask how resilient is the ETF market. That's next. This is Bloomberg.
Well, I still think just given the violence in the market, the dislocation, the risk aversion, the delayed selling, I would think that tech and the S&P 500 easily have another 10% down.
You can make a decent argument that around 2,000 to 2,200 could be a decent floor.
Relative value investing and cross-asset investing is back in a state where there are opportunities and there's a significant amount of risk.
So what's rational for every fund manager becomes irrational for the market as a whole. And then you get contagion. So it's going to get worse, unfortunately, before it gets better.
Some of our guests there are reacting, of course, to the market turmoil. So let's continue the conversation about the week's sell-off. We're back with Deborah Furr from ETF GI and James Bevan from CCLA Investment Management. Deborah, of course, our constant, thought is with the people that are losing their lives because of this pandemic. And you said actually it's very difficult to. I don't know whether you look at data, whether it's the number of infected, number of deaths, is it loss of economic activity, to see what happens to the markets next week.
I think it would be all of those things, and also how many tests are actually happening. I mean, in the U.S., there's 327 million people who basically only 8,000 have been tested, right? And if you look at other countries, the number tested is much higher. So I think it's a question of, do we have enough kits? And if you look at Italy, we don't have enough equipment to treat everyone who's ill. So I think if we have a large spike in illness anywhere else, that'll be an issue.
Well, what does that mean for more volatility to come in the markets?
Yes, I think there are three scenarios that we should consider. One is that this is a correction which is actionable, that prices will recover, that the number of cases will decline, and we'll begin to see more signs of China having leveled off next week. And if that's confirmed, then I do think the world will become slightly calmer than it is at the moment, because, of course, it is fear that is moving markets most. There is a second scenario, which is just this continues bad for another quarter, but at least there is a second half recovery. There is a third scenario, which is that this moves from being a demand shock to a full-blown supply shock with a credit crunch and a really nasty long-term bear market.
So when do you find out? I mean, what's the timeline of actually seeing what happens next?
There's an interesting admix of three factors. One is the hard medicine, what are the case numbers and what's happening. Secondly, what are the responses of the authorities, particularly in terms of monetary and fiscal policy? And thirdly, what is the mood of participants in markets? Because, of course, it is people who are moving prices, not the disease itself.
All right, thank you both. We'll be back with Deborah Furr and James Bevan. Now let's stay with this week's sell-off. Take a look at which ETFs have been hit the most. Here's our Danny Berger.
Francine, investors pulled more than $3.5 billion from European-listed ETFs so far this week. Of course, we still see net inflows for the year, about $15 billion. But here are the ETFs that got the biggest flows. Some interesting moves. Gold, that should be no surprise, topping the leaderboard. But the theme here really is that ETFs are doing what they should. Investors using the route to position themselves differently, these tactical exposures. So we can't pull away too much to say, for example, oh, investors aren't worried about investment grade. But there is someone in the market or a few players making these moves. Of course, the outflows, I think, much more interesting this week. So you see at the top there a UBS fund. This tends to be UBS's own money in here, pulling $1.5 billion. There were a couple of UBS funds like this that have the same amount withdrawn. Some bond funds, high yield. Of course, this is a really big area of stress. We heard companies this week like Cineworld saying in a worst case scenario, they wouldn't be able to meet their bond covenants. USA fund also seeing withdrawals, even though the other board showed a USA fund seeing inflows. So in general, the theme, pulling money out, figuring out how to tactically play this move this week, Francine.
Thank you so much, our Danny Berger there. Now, let's talk a lot about something else in the market. Monday's spectacular 25% crash in the price of crude has, of course, led to two European oil products closing their doors. Now, the three-time leveraged ETPs from Wisdom Tree are to be terminated, with the company blaming an extreme adverse move in oil futures. So could this be a sign of things to come? Well, let's get the details from Jacob Petersel, who's an editor on our cross-asset team. Still with us, Deborah Furr from ETFGI and James Bevan from CCLA Investment Management. So, Yakov, exactly what happened to these products?
Well, as you said, Monday was a wild day in the oil markets. Essentially, crude and WTI and Brent contracts ended the day something like 25% down. And what happens is that has reverberations across the whole universe of exchange-traded products that track these, the price of these futures, including two here in Europe from Wisdom Tree, which are 3 times leveraged. So as you alluded to, 3 times leveraged means that a downward move of 33% in those futures contracts means those products have to slip 99%, which effectively renders them equal to zero. And that's exactly what happened.
Are other ETFs at risk?
Well, so far, other triple leveraged oil futures contracts products have not yet bit the dust as these have. But with the sharp moves in oil futures recently, anything can happen.
Should products like this exist?
Well, that's a perennial debate. Regulators have basically implicitly said they should because they're available for trading. But I think the issue is that these are widely accessible, including to people who are so-called unsophisticated investors. And the danger is that they don't know exactly what they're getting when they buy one of these products.
Yeah, Deborah, is that fair? I mean, are we going to see actually some of these products used, a lot more by unsophisticated investors?
So I think you go back to the U.S. and in 2008, they actually said these types of products weren't appropriate for retail investors. And so there are limits in terms of who can buy them and who they can be marketed and sold to. I think what we've seen is certain people understand how leverage and inverse products work and use them and like them. And others have found that they don't understand them, because you can't buy even like an S&P 500 leverage or inverse and expect that you're going to know the outcome 5 days from today, right? Because they rebalance every day. Yeah. So I think you have to be careful that they're trading products and not investment products.
Deborah, speaking on Bloomberg this week, the vice chairman of BlackRock, Philip Hildebrand, says ETF markets have held up through the turbulence overall.
Piece of good news here is that the market worked reasonably well, even though we had historic moves. We can see this also in the ETF market. That's an important signal that the ETF market functioned. The market integrity was preserved despite this extreme move.
Deborah, I mean, same question that we asked Yakov. Do you worry that actually what happened to these products will happen to other similar products?
Well, I think one thing that's important to remember is these things are not actually ETFs. So ETFs are funds. These tend to be notes.
Yeah.
So I think you need to be careful that the way funds are regulated, ETFs are really mutual funds with the added benefits of being listed and traded on exchange. Highly regulated in terms of what they can invest in. Notes are really different. So when we've seen issues, and we have seen this in the past with VIX products, right? Same thing happened a few years ago. So you have to be really careful about the note products because what they do and how they do it is very different than ETFs and funds.
Yeah, and actually we're going to talk about VIX products a little bit later, actually, coming up in a couple of minutes. James?
I think that these products are perfectly reasonable, they are well understood, and they are very well published. And I would say this is in stark contrast to the closed-end fund split cap disasters of yesteryear, where all sorts of shenanigans went on in terms of cross-investing. And investors really couldn't tell what was going on. These vehicles and products are extremely transparent.
Yakov, what are you looking at for next week?
Next week, well, the market moves have continued to be quite violent, and anytime you see exchange-traded products linked to these kinds of assets, things can happen. But so far, as Deborah alluded to, these things have held up really well so far, particularly some of the bond ETFs in the U.S. There haven't been issues. Investors have gotten the exposure more or less that they expect, and so far, so good.
All right, thank you all. Yakov Petersel there, James Bevan from CCLA Investment Management, Deborah Furr from ETF GI. Stay with us. Now, coming up, if there's one thing gaining this week, of course, it's volatility. So we'll discuss using ETFs to bet on uncertainty. This is Bloomberg. This is Bloomberg ETF IQ Europe. Your markets, wow, what a week. Now, this is what we're seeing right now. Equity futures actually advancing. European stocks markets overall are trying to stabilize after a brutal day on Thursday. Most Asian benchmarks still staying in the red. Investors, of course, still worried that emergency fiscal and monetary packages won't actually be enough to stave off a global slowdown. And then a lot of questions about Christine Lagarde's press conference yesterday. So we see a move also in BTPs. Now, welcome back to Bloomberg ETF IQ Europe. Everything you need to know about the funds and the flows. I'm Francine Lacqua. So how can investors profit from volatility and volatile markets? Here's Danny Berger with the week's There's an ETF for that.
Francine, basically everything in markets has been tumbling this month except for one thing, volatility. Betting on higher swings in the market has paid off over the past 3 weeks, with the VIX itself surging to the highest level since the financial crisis. That means that a Wisdom Tree European-listed ETP that mimics a leveraged position in the VIX has turned nearly 300% in March. Now, volatility, it's become an asset class in its own right, and VIX tracking products have become popular for downside protection or tactical bets. It's especially true in the U.S. and increasingly so in Europe. So for how this product works, it tracks the performance of a VIX future that expires in 1 and 2 months and multiplies that times 2.25. It's really a prescient bet if you bought it recently. The VIX curve, it's inverted, which means that near-term contracts are more expensive now than ones that expire further out. Rare, because usually the future is less certain, so it's more expensive. Now, over time, these products generally do lose value. You have the cost of rolling contracts, and also just volatility tends to be low. But in instances like this, a very key instance, it can skyrocket and cushion some of those losses in a portfolio, Francine.
Thanks so much. Our Danny Berger there with the very latest. Now let's get final thoughts from our guests, Deborah Furr from FGI and James Bevan from CCLA Investment Management. Deborah, what are you looking out for next week? I mean, first of all, is there a liquidity concern when it comes to ETFs?
Well, no, because ETFs
it tracks the index.
It is as liquid as the underlying, but it's really important to remember most trading in ETFs, 9 out of 10 trades, are existing shares of ETFs just going between different people who want to either buy or sell, right? So it's not touching the underlying market. I think as we see markets in bear territory, many people are looking for, is there a buying opportunity? So as the numbers change, as more news comes out, but I do think the messages from politicians do raise some concerns in terms of what they say and how they say it. So I think people are a little bit concerned looking at volatility, looking at valuations, and then looking at what's being said.
Yeah, James, do you agree with that? And actually, how do you use ETFs?
Well, I absolutely believe that it's essential to work out where you want to stash the cash in the current period of uncertainty. And I think heading off to the Treasury bond market is an accident waiting to happen, because at some point those yields will reverse. It is inappropriate, from my perspective, for the 30-year US yield to be 1%. That just does not match the long-term fundamental economic prospects. So for me, it's about sectors and styles, and I'm looking at quality and growth. I think that admix is a very powerful driver of forward returns in the sort of climate that I expect to persist over the next 6 months.
I mean, forget 1%. Does the 10-year US actually the yield go, negative?
I think it has every chance of going down to zero. I certainly think that the Federal Reserve will cut rates again and resume QE. And then the real issue is, can governments get the economies moving, or are we in for a long, slow grind?
How do you see Treasuries developing?
I think you're right. They have the chance to go down. And I guess the challenge is they really don't want people to go out and go shopping. So how do you stimulate the economy when you want people not to be out social interacting?
Yes, and there's a lot of talk about infrastructure spend as being the great hope, but in practice, getting the ground broken and projects commenced is really very long-term stuff. Cannot be simply implemented at the flick of a switch.
Are a lot more people going to go back home and actually build more ETFs, given we're expecting volatility?
I don't think people are going to build more ETFs. We already have a pretty big toolbox. I think where we do see growth happening is probably ESG, fixed income, and probably thematics is another area where sectors don't well represent what people want to invest in. So kind of to your point, if you want to invest in factors or styles, they want ETFs to look at very narrow slices that will define it. And so I think that's where we're seeing innovation.
But in a huge sell-off like we saw this week, does thematic actually change? I mean, what kind of themes do you go after? Does it change the market somehow?
Well, I do think that people still want ESG. So all of a sudden there's this awakening of the impact of climate, governance, other issues. And so we are seeing that people are putting money into those products, not just in Europe where we've seen flows for a long time. But I think a lot of people are going back into bonds because they're looking for some protection. People are going into gold. And they're trying to avoid things like airlines. I mean, you've seen prices decline significantly. All
right. Thank you both for joining us. Deborah Further, managing partner and founder of ETF GI, and James Bevan, chief investment officer at CCLA Investment Management. Now, that's it for this week's special edition of Bloomberg ETF IQ Europe. We'll be back next Friday. This is Bloomberg.